You want a risky trade? I'm going to give you a risky trade. We're going to talk about trading short straddle positions, and that is a bearish strategy. And it involves selling both a call and a put option at the same strike price and expiration date. The goal of this strategy is you want to profit from a decrease in volatility and or a small move. And I mean small in either direction. So in this example, let's assume the stock price is about $45 and we are selling both a call and a put at $45. That's the strike price. I want us to imagine that we're taking in a $100 premium for each contract. Okay, so that's $1 per share. So we're going to profit from this by collecting just the premium. That's it, from selling the call and puts. If that stock price moves lower than the strike price of the contract, we're going to make a profit. However, if that stock price increases above the strike price, we're going to lose. And these losses, unlike trading vertical spreads, these are not defined. How much we can lose is unknown. That's why these plays are extremely risky. Our maximum profit for this trade is equal to what we collected when we entered the trade. And this full profit, we only get that when this contract expires at or below the strike price of the contract. So in our example, $200, that's the most we can make on this trade. The max loss for this trade is equal to unlimited downside risk. It's unlimited, less any premiums collected. This loss is realized when the stock price expires above the strike prices of both contracts. So our downside on these trades is big. We want time decay to add up, and we want the underlying to not increase in volatility. In essence, we want that stock to remain flat. We want people to ignore it. Now, sometimes volatility will increase, so you got to know where would you be break even. It's simple. To the upside, we take the price of the call. We add in the premium that we received when we opened the trade. So a strike price of $45. We collected $1 per share on the upside, $46. On the downside, take the strike price minus what we received, the dollar, is $44. Now the risks associated, you got to know these. Our downside, it's unlimited. Okay, the stock can go to zero. Our upside potential is limited to only what we received in premium. That's it. So if there's an unforeseen event that causes volatility to spike, or if there's an unexpected move in either direction, you're going to lose money and you're going to lose it quick. But we can manage the risks a little bit. Use a stop loss order. That's just an order that's placed with your broker to buy or sell once your stock reaches a certain price point. Okay, this is going to help you limit your losses. You can hedge your positions, and that's just when you take offsetting positions to mitigate your risk exposure. So in our example, if the underlying is moving up from the $45 price, you buy a call at $50 to $55 to limit your losses to that strike price. On the downside, you'd think of buying a put option at $40 to $35 to limit the downside to that strike price. Here's a few tips if short straddles are something you're interested in. Pick less volatile stocks. This is going to help minimize losses if there is an unexpected spike in volatility or an unexpected move in either direction, because they don't move a whole lot. Choose your expiration dates wisely. So if you pick an expiration date too far out, well, then you run the risk of volatility coming into the market. Cap your profits. Listen, although that premium is the most you can make, you might want to consider holding on to about 50% of the potential profit. So in our example, if you can get out with $100, maybe you want to get out. Look for a stock that made a big move, because oftentimes after we get a big move in price, what happens? We get a nice consolidation. Now, yes, these can be profitable if you do it correctly, but these risks are real and you have to manage it correctly. By following those tips, you can help mitigate some of those risks. So I want you to think about something here, because not just trading stocks and options is the way to make money. So I want you to imagine, let's say you have a list of 101 best dividend stocks that you could own today, right? That's obviously going to give you a head start when it comes to finding those high yielding investments. And we got that. It's a free download, right? It's 101 of the best dividend stocks that we look at here at NetPicks. We have some videos on our channel here about dividend trading and dividend investing, something you'd want to take a look at if you're ever thinking of having a good retirement. Make sure you hit like and subscribe. We'll talk to you soon.